right, shifting focus to our next conversation, we're talking to Happiest Minds. What's in store for the tech company going into the second half of FY25? We'll be joined by the management shortly, but first, Rucha is setting up the conversation for us with background on what's been happening with Happiest Minds.
Right, thank you, Tamanna. So I'll give a brief about Happiest Minds. Now, this one is a digital transformation, IT consulting as well as services company, and it also enables digital transformation for enterprises. Now, let's talk about the Q2 numbers. Q2 numbers were largely weak, but in the medium term, the company has also mentioned about its guidance. In terms of constant currency revenue growth, the company is set to achieve around 30 to 35% over here, but EBITDA guidance largely remains flat at 20 to 22% along with other income. So EBITDA margin can see slight bit of a downturn or a flat range is over here. So number one, what the management will be talking about is the levers that will enable them to maintain such kind of margin and also achieve the 30 to 35% CC revenue growth. Now, in terms of headcount also and the demand environment also, since the company has added about 19 employees in the second quarter, the perspective on how the demand is turning up, especially in the banking space, which largely most of the IT companies are talking about a revival. So that is the second point which the management will be mentioning about. And the third point over here is that the company had mentioned that the first half, that is the quarter one and quarter two, will largely be soft, but second half will likely recover. But a point here to note is that second half is largely full of furloughs, which would probably imply a softer growth. So how will this growth in second half be revived is what the question is to be asked. Apart from that, strategic growth outlooks and the expansion plans, organic as well as inorganic, is what the management will be talking about with us today.
Okay. Thank you for that, Rucha. So that's where the conversation. That's where the conversation actually starts. Venkatraman Narayanan, Managing Director and Chief Financial Officer at Happiest Minds Technology, is with us. Mr. Narayanan, very good morning to you and great to have you on. I'm going to start with a broad brush question first. What does the Trump era being ushered in and the outlook on the US economy mean for Happiest Minds?
The first thing is Trump is seen as a business-friendly president, and so I'm sure he's putting together a team which will be business-friendly. While there could be some sort of hiccup on the immigration, which will be largely to stem illegal immigration. We are not playing in that at all. We are all looking at how the legal processes on immigration get strengthened and streamlined. So, given the fact that he is going to be going behind illegal immigration, I'm sure that should not have an effect on us. But at the same time, the legal part of it, he'll streamline it. He'll be a lot more business friendly is what our expectation is. And so we don't expect any fundamental changes from where it was over the last 3-4 years.
So just drilling down on that, you're not expecting any up move in terms of discretionary spends, demands, or are you seeing green shoots on that already? Because the first half has been a little tough for the sector and for you as well.
Actually, thanks for bringing that up. I was talking about the here and now, which is about immigration. But yes, the longer term trend would be softening of inflation, which is what he's going to be focused on. Being business friendly, he's going to cut taxes, which would hopefully lead to a lot more of capital formation and expenditure. So with all of that happening, the negative being obviously this talk about cutting government expenditure. He has set up a team which will look only on that. But we don't. The Indian IT industry per se is not so much involved in the U.S. government business, but it definitely is a part of the overall spend from the U.S. government on IT. But if you look at it, private sector spend should strengthen. Capital formation should strengthen, and to that extent, with tax cuts and with the competitiveness being brought back into market, people will want to spend on IT. So when I say discretionary is largely those things which are postponable, but when they are so integral to the business, they are no longer discretionary. And when the competitive setup and the landscape is becoming business friendly, the spends will have to happen. And that's how, the spend into the IT industry is also going to be led, is what our reading is. And in fact, if you look at the large companies like Accenture, their commentary also portrays a similar kind of sentiment.
Venkat, morning, Neeraj here. Good talking to you. Been a while. Just trying to understand, Venkat, could this January be slightly different than the previous Januaries in that typically the budgets would be getting firmed up and awarded in Jan, but this Jan we have the swearing in press ceremony of Donald Trump on Jan 20th. So could decisions get a bit delayed in that maybe they get firmed up in February instead of January, and could that have an impact on Q4 for Indian IT companies?
Again, January, February, these are the 2 months when budgets get talked about, discussed, and they are aligned into the growth targets for the next year. Our discussions are also pretty much leading to the same. And when I talk about budgets and the spend on IT, it's largely for the top 5 or 6 companies in our kind of companies customer list. But for the large guys, we are talking about 200 to 300 companies in discussion with the large companies on the budgets and how they should get aligned. You are right. January, February would be the time frame in which people will start talking budgets, and they are looking at budgets more on a quarterly, rolling quarter basis right now. It's no longer, for an entire year, there are only indicators of the spend people talk about, but they are getting evaluated on a quarterly basis, and it's different for different companies. For companies which are private equity funded, they are looking at it on a quarter-on-quarter basis. Large corporates, they look at it on a holistic basis for the entire year and then see how to streamline it as they go from one quarter to the next. But yes, January, February could be the time into which we'll all be in discussion with our customers, and there could be I would think a push by a 1 month or a 2 month, if you really want to align that to our budgetary cycles.
Okay, so maybe not impacting the whole of calendar, but maybe Q1 or Q1 of 2025.
Q1 and 25, the calendar year, the Q4.
Year. Yeah, Q4 for this year. Okay, fine. So then therefore, just to figure that out, that would that mean that maybe just in the outside chance that your Q4 numbers may not quite live up to what the otherwise hope would be, it will be a deferment, if you will, so it gets captured in FY26 for Indian IT companies. Would that be a fair assumption?
I would think so. See, Q3 this year, I'm just talking about ourselves to start with. We have lesser number of working days, which is and the furloughs which happened. So 61 days compared to 64. So you've lost a couple of percentage points, if not more, on that front. From there, so your base gets corrected. So Q4, one, there is a base effect. The second is obviously the budget cycle push out, and maybe companies looking to wait and watch for maybe a couple of weeks to see what Mr. Trump has to offer, what he's pushing out on. So I would think the entire industry was hoping for a good H2, but I think it's going to be a little bit more tempered than what expectations were earlier during the year.
Is that, Mr. Narayanan, more specifically, is it just because of the delays in change, or do you think that this sense that a Trump administration is going to change a lot of basic factors that have been troubling the US economy or the demand scenario are overblown?
No, I wouldn't say overblown. See, the bright speck in the global economy right now is US and India, for that matter. So to that extent, there are a lot of eyes focusing on that market. The spends, for example, for us is 65% is US. For most large IT companies in India, that's the kind of spend pattern coming in from that geography. So, small moves, they say, if they cough, we get a cold. It's similar to that. You're going to see a little bit of realignment, and the wait and watch will be there for a couple of months, at least for sure, in Q4 or Q1 of next year.
Just one last bit. I mean, you had, of course, your subsidiaries merger in various, which I think got completed this month itself, Mr. Narayanan. Just give us a sense on the impact which you're going to see to margins or revenue. I know overall you streamline processes, etc. But what are the financial implications that you see, or how does it add positively there?
See, last year we declared EBITDA of between 22 to 24%. In fact, we were ahead of the guidance that we had given of 22 to 24. This year we tempered it down to 20 to 22%, primarily because of two factors. One is both Aureus and Pure Software come in at a slightly lower margin profile than Happiest Minds. But that's the nature of how IT companies are. The larger you are, you've got certain benefits of scale, and so you are better on the margins, and the pricing power is slightly more than the smaller companies. So now that they are part of the Happiest Minds family, the first order of business would be to streamline business processes and make sure that we are able to get that margin profile slightly up. The cost of capital available to Pure Software and Aureus would have been slightly higher than what is available to Happiest Minds. The working capital structures, the ability to give credit, the ability to even go into markets. We have a team of 45 salespeople. They come in with their sales team. Now we are able to, cross-sell and do a lot in terms of optimization. But all of this takes time. It takes about 2 to 4 quarters, and that's what we'll be focused on. But just to highlight, the 20 to 22% EBITDA guidance that we have given for this year takes into account a few things. One is the new business engine that we've put in place. We verticalized the company last year, which is a big change that's happened to us. And on top of that, we are now overlaying it with a new sales engine. That there is an investment that goes into it. We have also invested significantly during the first half into generative AI. About $2 million is what's gone into the investment into this business in the first half. We are looking at something similar, slightly lesser, I'm sure, during the second half. And we are generating revenues, but a pace of growth in revenues in that business has to start showing up and has to cover up for the costs and the investments that we're making. So the margin is not primarily because of just the integration part. There is, of course, an element, but the larger thing is the investment that we're making. The third big point is came with a Pure Software, one of a good platform, award-winning platform called Banking as a Software, Artha Banking Platform. Now we are taking that to US and also taking into India, because right now they sell into Southeast Asia and Africa. We're taking it into India. That will also require some bit of investment. So most of this, or a lot of this, I should say, has been factored in into creating this near-term, short-term guidance of 20 to 22. And hopeful that we'll be able to beat it. But yeah, that's what we are focused on right now.
Okay, Venkat, we'll leave it at that. But wishing you and yours season's greetings. Have a great Christmas and all the best for 2025, a strong 2025.
Thank you. Same wishes and great wishes to NDTV as well. Thank you very much.
That's the view from Happiest Minds. Cautiously optimistic or optimistically cautious, whichever way you want to put it. And that's the state for the market as well. I mean, quiet as she goes, based on what it had opened, about 1% or slightly less than 1%. I don't know if it's changed in the last 10 minutes. It's going to be quickly pull up the Nifty before we take that break.